how rising interest rates affect your personal finances and what you can do about it. You just got your credit card statement and bam! Your minimum payment has shot up. Or maybe you just saw your mortgage payment jump by $200 per month. Why is this happening? Why do interest rate hikes hit your wallet so hard? And most importantly, what should you do now? You're not alone. This is an issue more and more Canadians are facing. In this video, I'm going to explain not only why this happened, but also how you can handle it smartly. Ready? Interest rate hikes decided by the Bank of Canada are an economic necessity to control inflation, but they cause real disruption for many Canadians. Whether you're a homeowner, a renter, or dealing with personal debt, you've probably noticed your finances are under increasing pressure. Mortgage payments, consumer credit, and even student loans are becoming more expensive as rates rise. But why is this happening? And more importantly, what can you do to face it smartly and without panicking? Before understanding how it impacts your personal finances, it's important to first grasp why the Bank of Canada raises interest rates in the first place. What is an interest rate and why does it fluctuate? An interest rate is the cost of borrowing money. When you borrow, you don't just repay the amount you borrowed, you also pay extra fees, called interest, for the duration of the loan. These rates are set by central banks, like the Bank of Canada, to regulate the economy. Interest rates affect the entire economy, from business loans to household debt. The Bank of Canada adjusts these rates to achieve two main goals. 1. Control inflation. When inflation is too high, it makes life more expensive for Canadians. By increasing interest rates, the Bank of Canada makes borrowing more expensive, which slows down spending and helps control inflation. 2. Maintain economic stability. During periods of rapid economic growth, raising interest rates slows down consumption and helps prevent the economy from overheating. How does the rise in interest rates impact your personal finances? When the Bank of Canada raises its interest rates, it leads to a general increase in borrowing costs. In practical terms, this means the cost of mortgages, personal loans, and credit cards rises, which can add more strain to your budget. Interest rate hikes can affect various aspects of your financial life. Let's take a closer look at how this plays out. Let's use an example. Imagine you have a $300,000 mortgage at a 2% interest rate. At this rate, your monthly payment is $1,200. If the rate increases to 3%, your payment could rise to $1,400. That's an extra $200. At first glance, it doesn't seem like a huge difference, but when you combine this increase with other debts, like credit cards or personal loans, it can seriously impact your monthly budget. Credit card interest rates are often much higher than mortgage rates. For example, if you have a $5,000 balance on your credit card with an 18% interest rate, you could end up paying several $100s a year in interest just to maintain the balance. An increase in interest rates on these credit products can worsen the situation by raising the total cost of your debt. If you have student loans to repay, you know it's never easy to manage this debt after graduation. If interest rates rise, the repayment period for your loans may extend and monthly payments could become higher. At the same time, the rise in interest rates isn't the only pressure on your budget. Inflation, the general increase in the prices of goods and services, is also eating away at your purchasing power. Inflation makes things like gas, groceries, and housing more expensive. Even if you're not taking on new loans, these price hikes force you to adjust your budget to keep up with the higher cost of living. How to manage rising interest rates. It's easy to feel overwhelmed by all these increases, but there are practical and accessible solutions to better manage this situation. Here are some strategies to ease the financial pressure and regain control over your money. Strategy 1. Prioritize paying off high-interest debt. Credit card debt and personal loans are often the most expensive due to high interest rates. When facing rate hikes, it's essential to prioritize paying off these debts to reduce extra interest costs. Here are some practical tips. Consolidate your debt. If you have multiple debts, consider consolidating them under a loan with a lower interest rate to simplify payments and reduce costs. Aggressive repayment. Use methods like the avalanche method, paying off debts with the highest interest rates first, or the snowball method, starting with the smallest debts. If you have a variable rate mortgage, switching to a fixed rate could be a good option. While fixed rates are often higher in the short term, they offer more security in the long run. Even if your debts are the priority, it's also important to revisit your budget. If your monthly payments are increasing, you may need to cut back on certain expenses to compensate. Here are a few ideas. Cut back on expensive entertainment, limit dining out or costly activities, and opt for free or low-cost leisure activities like walking, hosting friends at home, or participating in community events. Review subscriptions and unused services. Go through your monthly subscriptions, streaming, magazines, apps, and cancel the ones you don't use. If your monthly payments are too high, refinancing some of your debts could be a wise move. Refinancing a mortgage or personal loan allows you to extend the loan term, thus lowering your monthly payments. Of course, this could increase the total loan cost over time, but it can provide immediate relief. In times of economic uncertainty, having an emergency fund is crucial to avoid resorting to expensive credit. An emergency fund of 3 to 6 months of essential expenses can help you navigate tough times without falling further into debt. One of the most important things to succeed in navigating an ever-changing economic environment is to keep educating yourself financially. The more you know about money management, the better prepared you'll be to face unexpected challenges. Additionally, taking the time to understand how economic decisions, like interest rate hikes, impact your daily life will help you make more informed financial choices. Interest rate hikes can seem overwhelming at first, but with the right strategies, you can not only survive them, but come out stronger. The key is to stay calm, take smart actions, and adopt a proactive approach. By following these practical tips and adjusting your financial habits, you can reduce the strain on your budget and regain control over your financial situation. So, what are you waiting for? Start today by taking steps to ease the financial pressure you're facing. If you found this video helpful, feel free to share it with your friends and leave a comment telling me how you're handling this situation too. And most importantly, subscribe to the channel for more practical financial tips tailored to Canadians' realities.